The company that helped find bin Laden is now revolutionizing modern warfare with AI. Palantir's technology is making Ukrainian drones devastatingly effective, and their stock is soaring. But there's something about their valuation that should worry every investor. I'm Evan Goldstein. I'm a licensed professional engineer and a data scientist. The algorithm has brought you here to AI Capitalist, where I help business leaders like you learn how AI is helping drive profitability. We covered Palantir's use of AI to help Ukrainian drones become vastly more deadly on the battlefield in another episode. So I thought this would be a good opportunity to look at the company's financials. Of course, I'm a licensed engineer, not a licensed investment counselor. Nothing I say here constitutes investment advice. In just under 11 months, Palantir's stock has exploded 162%, driven by excitement around AI and the growing chaos on the global stage, which could boost the need for its military and intelligence-focused data analytics software pretty substantially. But is the company's shiny new valuation actually backed up by its fundamentals? Let's dive in to see if their stock is really a smart long-term play. SaaS, or software as a service companies, are a hit with investors because when they're done right, they can churn out steady recurring revenue. Their economic advantages can become even stronger over time as clients get comfortable with their new systems and are less likely to jump ship for the competition. Palantir's SaaS offerings are all about machine learning and big data analytics, helping organizations sift through mountains of information to gain insights and work more effectively. They've even paired these technology with large language models, like what powers ChatGPT, to help clients make quick, informed decisions. While it's not the only player in data analytics and generative AI space, Palantir stands out because of its focus on government, military, and law enforcement clients, which might use tools in ways that regular businesses, let's just say, they're a little afraid of. Many people associate Palantir with the US government tracking down Osama bin Laden over a decade ago. And recently, they've taken on a controversial deal with Immigration and Customs Enforcement to provide profiling tools during the Trump era, despite some serious media backlash. They've also been involved with the US Army's Maven targeting system, which is a project that Alphabet might have dropped because of its sensitive nature. As global tensions are on the rise, Palantir has a solid chance to grow its contracting business, especially since it already deals with the armed forces of Ukraine and Israel. Much of Palantir's impressive gains in 2024 can be attributed to increasing global uncertainty and the overall hype around AI. But let's not forget, they're also seeing some solid operational momentum. Their second quarter revenue bumped up 27% year over year to $678 million, thanks to the demand for their data analytics platforms. Most of Palantir's recent growth isn't even coming from the government clients that put them on the map. Now it's the private sector leading the charge, especially in the US, where commercial revenue skyrocketed 55% year over year, hitting $159 million, which accounts for about 23% of the total. So this thriving commercial side suggested the controversies linked to their government work aren't really hurting their reputation, and if anything, it might even give them a little bit more credibility. But leaning more on private sector growth means that Palantir is going to have to compete with well-funded rivals like Microsoft, who's not only the world's biggest SaaS company, but they also have got good name recognition and possibly a more sophisticated AI game thanks to its stake in OpenAI, the brainchild behind ChatGPT. So this is all great for Palantir. But just because a company is good doesn't mean that it's a smart investment. And this is where potential buyers need to take a look at Palantir's valuation before jumping on board. With a forward price-to-earning ratio of 100, calling Palantir price for perfection is way off. This PE ratio is sky high compared to the S&P 500's average of 25. And even Microsoft's PE is more reasonable at 32. So given all this, it looks like Palantir's stock might struggle to keep up with its impressive rise, and current investors might want to consider pocketing their profits.